Hello, my name is Doug Greenberg. I'm the president of Pacific Northwest Advisory. Thank you for tuning in for December 2023 5 slides in 5 minutes. Inflation is down but not out. Inflation peaking in 2022 at 9% has been affected by the increase in interest rates by the Federal Reserve. It has taken time for the effects of interest rate hikes, the supply chain imbalance, and COVID restrictions to reduce the year-over-year inflation rate. But keep in mind, prices year over year have not gone down. They have just slowed the rate of change. We have not seen deflation, and consequently, prices are still very high, as you can see by the chart on the right, are up close to 20% cumulatively since January of 2020. This will continue to be a drag on the economy, especially as unemployment increases and excess savings decreases. Our economy is navigating a sea of risks, each with its own severity and potential to disrupt. If these risks were to materialize, the present value of economic loss could be substantial, especially if the hit to the economy is delayed. When plotting these on a chart, the focus is on the northeast corner where the highest risks lie. But it's not all about doom and gloom. For the first time in quite a while, we're seeing not just downside risks, but also the possibility of positive outcomes. For instance, if the supply side of our economy, which includes labor force and productivity growth, show real vitality, then the US could experience stronger growth. We could see higher GDP, an increase in profits, higher stock prices, and a robust real estate market, all without the shadow of inflation looming over us. Now, this isn't the expected scenario, but it's possible. With potential growth at around 2%, we're looking at an economy that has room to grow in a healthy way. But it is a delicate balance because if the upside scenarios play out and we tap into the fundamental strength of our economy, we could find ourselves in a period of prosperity that outpaces all expectations. Now, we are facing a potential constitutional crisis by early 2025 if effective leadership isn't established. Our debt to GDP ratio, already at a critical 100%, is projected to soar to an alarming 180% by 2051. This higher for longer debt scenario means we're spending a growing chunk of our fiscal revenue just on debt service, expected to reach 7% of our GDP. Government choices will be tougher, especially to avoid defaulting on debt. We're in a tight spot, with partisan divisions threatening our ability to manage long-term entitlement programs, defense, and discretionary spending. The debates to raise or lower taxes are not just political squabbles, they represent real significant long-term risks. The severity of these risks and their impact become starkly clear, prompting us to consider the serious consequences for our economy and society if these issues are not addressed properly and effectively. In past recessions, like those in the 70s, 80s, 90s, 2001, and 2008, people often ended up spending savings because they lost their jobs. Usually, savings would drop because people had less money coming in. But in 2020, things were different. When the recession hit, people started saving more money. Why? Well, because of the lockdown, everyone was stuck at home. We were not going out to eat, traveling, or attending events, so we weren't spending as much. Plus, the government helped a lot with extra money from stimulus checks and unemployment benefits. By the end of 2021, though, people began to use up these savings. As we look ahead to the rest of 2024, this means American shoppers might not be able to help the economy grow as much before. They're a big part of what keeps the economy moving, and now they're starting to pull back. Another thing to think about is student loans. Lots of Americans, about 44 million, have student loans, and the average debt is around $38,000. For a while, they didn't have to pay back these loans because of the pandemic, but that break ended in October 23. Now, with the average person making around $4,000 a month and loan payments being about $300 a month, a lot of people must spend a good chunk of their paycheck on their student loans again. Surveys show that many folks, especially those with college degrees making between $50,000 and $150,000, are finding it harder to pay their bills because they must start paying back their student loans. This could mean more trouble for the economy. Strong stock market performance, moderating inflation, and tight labor markets have allowed consumer sentiment to rebound after its trough in June of 2022. This summer saw a less gloomy consumer with strong sentiment gains in June and July. However, the fall is splashing some cold water on this exuberance, and higher gasoline prices and the gradual pass-through of higher interest rates to borrowing costs likely weigh on sentiment going forward. When investors feel gloomy and worried about the outlook, their natural tendency is to sell risk assets. However, history suggests that trying to time markets in this way is a mistake. This slide shows consumer sentiment over the past 50 years with 9 distinct peaks and troughs, and how much the S&P 500 gained or lost in the 12 months following. On average, buying at a confidence peak returned 3.5%, while buying at a trough returned 24%. Importantly, this is not to suggest that U.S. stocks will return anything like 24% in the year ahead, as many other factors will determine that outcome. However, it does suggest that when planning for 2024 and beyond, investors should focus on fundamentals and valuations rather than how they feel about the world. Thank you for taking the time, and if you have any questions, please reach out. Thank you.